Okay, good morning, everyone, and you're very welcome to our fourth webinar of the week and our last one for this results season. For anybody who's coming back once again, you're welcome, or if you're joining us for the first time, my name is Mark Tobin. I'm the founder of Coffee Microcaps, and you're very welcome to this morning session. I'll quickly run through these intro slides and then we'll get straight into it with our first presenter of this morning's webinar. Quick mention to DMX Asset Management, who are our 2026 virtual event sponsor here at Coffee Microcaps. If you are looking for an active manager in the small microcap space, please do check out their two funds on their website and the relevant PDS and TMD documents, or indeed reach out to Stephen or Michael if you have any questions. As always, a very warm welcome to our friends from ASIC if they're joining us this morning. For anybody who doesn't normally attend the companies we tend to have presenting on here, capped under 300 million, that is our definition of microcap, in revenue and approaching cash flow break even, or are indeed already profitable, as some of our companies are here this morning. So we tend not to then have resources and biotechs with those first couple of filters, what I like to call industrial microcaps, which is a catch-all for everything else, which can be retail, financial services, technology, industrial services, professional services, kind of anything else that falls out of resources and biotech. This morning's webinar, we've got 4 companies presenting this morning, 30 minutes for each, which would break down roughly into a 20-minute presentation and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A function rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel on Monday morning. And just as a quick aside, all our previous webinars from this week are already up on the YouTube channel if you want to go back and check out any of the other 17 companies that are presented so far this week. Twitter, YouTube, LinkedIn, and a free monthly newsletter, which will be going out middle of next week, which will do a recap of all the companies which have presented this week. Our schedule for this morning, we're going to be joined shortly by Tom Dusseldorp, CEO of Australian Vintage. And he, I see, has just joined us now. We will then be handing over to Josh Simons from VNL Group. From there, we will be welcoming back Brendan Malone, regular presenter here from RAIZ Invest. And then finally, we are going to be heading out to Adelaide, and we will have Rob Veitch, CEO of Aerometrex, coming back to give us a rundown of their result. So without further ado, I am going to stop sharing my screen and hand you over to Tom. Tom, if you want to just bring up your screen, I'll let you know once I can see the cover slide. Yeah, I can see the cover slide of your presentation now, Tom. Feel free to take it away.
Thanks, Mark. Yeah, appreciate the opportunity to come back and present again. The last time I presented here was late last year, obviously our full year last year results, kind of setting out for the potential year ahead. So great opportunity to kind of check in, give everyone an update on how we're going, and really it's an exciting story, because the last time I was here we had a lot of innovation that was launching into market late last year, and so we've got some of the updates on how that's going. What I wanted to start with was just our kind of a summary of our half year results. Basically, the key message is that it's in line with where we expected it to be. The challenge we have, obviously, is that the numbers are not reflecting all of the work that we've done to really set the business on a kind of turnaround plan in which we articulated to the market. Australian Vintage has been performing over a number of years, not to anyone's expectations, a combination of factors. And we've now identified kind of all the areas we need to work on to really turn the company around, hence our current kind of market cap. So there's a full presentation of our half year results. This is the financial summary around net debt and growth, as well as, a key component of our strategy in terms of inventory management, and how we're kind of getting in line. But what I wanted to use this time for was to really kind of give a bit more color around kind of where we're going, what we're seeing coming through in the background, because, you know, unfortunately in half year numbers, it's a point in time measure that doesn't really kind of reflect, you know, what we're seeing from a trajectory perspective. I wanted to recap for everyone, kind of new and potentially existing investors, what is the strategy or underpinning the strategy of what does a turnaround mean? It's really very simple. You know, we have a guide to achieve 20 million free cash flow over the 3-year plan. Historically in the business, we've been, you know, able to achieve these kinds of numbers. So it's not an unprecedented goal, but there's a number of ways that we're going to get there. And so wine companies being a one point in time of the year, being a vintage where grapes are pulled off vines and stored and produced, you know, inventory alignment to your needs is massively important in terms of free cash flow and profitability. And so we've done a lot of work in the half around how we get our inventory in line. And you know, we put a figure around 40 million litres, and I'll give a bit of colour as to how we're going on that. Another part of our business is that we are very UK and Australia, New Zealand centric. So there is still a phenomenal opportunity for us across Asia and North America. And every FMCG company says that. So I'm not standing here kind of saying this is the panacea. You can see by the ambition of 20 million in terms of net sales is not a dramatic hockey stick ambition. But what we're seeing is now the conversation with our innovation and our differing approach to wine, we're getting a lot of traction in this region. And so, you know, that's really compelling, and I'll give a bit of color on that. And then finally, we needed to ensure we were doing things differently. You know, the world of wine has been unfortunately stuck in a self-fulfilling prophecy, a lack of innovation, a belief that doing the same thing over and over again will generate different results. And, you know, Australian vintage has really been counter to that thesis. You know, our leadership in zero alcohol wine showed industry innovation and kind of first to market. And now we've got other propositions, which again, I'll take you through, that's showing phenomenal promise for the business underpinning the plan. So a really clear strategy in terms of what are the key metrics we're going after. But I wanted to also kind of give some comfort that, you know, a lot of people say, well, how's liquor going? You know, where's wine sitting in the world of wine? Now, this is Australian data, not global data, but it's a good proxy for more mature liquor markets. And wine, for the first time, you know, is starting to see growth. You know, what has been led in terms of RTD, spirits, you know, those kinds of categories driving kind of consumption. Wine is starting to really kind of turn. And there's a lot of reasons as to why that's happening. All new occasions have emerged. You know, if I talk about the industry stuck in tradition, consumers were demanding of the industry that it change its way it approaches them, because they're changing the way that they want to consume beverages. Yes, there is a macro decline in alcohol consumption happening across the world, across a number of demographics. But there is still plenty of alcohol being consumed, but they are being consumed in different ways. You know, more social, more outgoing. People are looking for lighter styles, more refreshment. You know, and this is where, as you can appreciate, heavy reds, big Cabernets, large Shirazes, you know, they're not really meeting the needs of where consumers are going. And so you can see why wine disproportionately gets hit by that change in consumption and behavior. And so, you know, that's really playing out in the data. But we're across it, we're aware of it, and this is why a lot of the work we're doing is about accessing those opportunities. You can see here, I love a bubble graph showing kind of volume and growth. So the size of the bubbles, the volume, and the far right to the graph is the growth. And you can see there's still plenty of growth. It's just in those occasion-led varietals, you know, flavored sparkling, Prosecco, on fire, rosé, Pinot Gris, everything light, bright, fresh. And those come as naturally lighter in ABV in terms of alcohol. So really driving the growth in wine. But when you look at those big, heavy red bubbles to the left of the line, you know, it's hard for those other categories to overtake the volume and value of those kind of pulling down. And so that's really the shift we're seeing in the wine industry. But I'm, you know, obviously very buoyant about wine's role in consumers' lives. You know, we all have wine at pivotal moments throughout our existence, and will continue to play out that way. We've just, as a business, got to position ourselves in those moments better. To explain that and give some color to that, this is a great example of what I mean. We are a very red-centric business, and historically that has been kind of the core driver of the organization. Hence why AVG has had a disproportionate impact in terms of that change in consumer behavior. So inventory management and how I get our business in line is a massive part of that kind of turnaround story. So you can start to see the work we've done in the half and how that will yield into the future. If I jump into that, what is it that then the heart of the strategy from our branded perspective? There's three key things that we've been doing. One is hold the core. Yes, we're a red-centric business. Yes, McGuigan Black Label Red sells nearly over 50 units per store per week in Australia. It's a critically important portfolio for us globally. So we need to make sure we're holding that position in our key markets while we start to layer in and add on strategically, growth drivers for the organization. What are those? Premium and light propositions. We've done a lot of work in that space. And innovation, the critical lever of any organization, more important in the wine industry than ever. We're seeing actually a phenomenal appeal for that proposition. And so that's why I'm kind of really excited to finally see some scan numbers. I've been talking about this for nearly 2 years. I bet my entire career on it. So we took a big bet, but it's paying off in a big way. And so we're just really trying to keep up with that momentum whilst also doing a good job on the core business. What does that mean for core? How are we going? Really well. ANZ was in decline, for a couple of years, and we've really worked hard to turn that around in one of our key markets. A focus on investment, a focus on customer and consumer. We partnered with the Australian Cricket Board. We had a really good summer of cricket with McGuigan, really good store weight and focus, and we're in 4% growth financial year to date. I think FMCG and brands that are loved by consumers like McGuigan, where you invest, where you focus, you get phenomenal results. But on the flip side, in the UK, we've seen a phenomenal amount of tax inflation come into the market as the UK government's adding more and more layers of tax, both in excise and in duty and in recovering recycling in terms of different taxes and layers. So that's driving the ASP of entry-level wines in grocery up. So McGuigan is declining, but so is the Australian wine category. So we're a little bit faster than the Australian wine category in terms of the decline, which we're looking to control. It's a couple of customers. But I wanted to be transparent that, what we've done in Australia and New Zealand, the strategy is working and we're now implementing that in the UK. And so we've really got a good handle on our core. We're really clear on now what we need to execute. And like I said, for the half, the numbers coming through are kind of as we expected. And so that's, comforting to know and see that we're getting that job done while the exciting stuff is moving faster than we had anticipated. What are the exciting things? Well, we made some investments, so you'll see in the half year numbers that the cash out is higher than last year. Why? Well, because we've invested in some things. We bought Madfish, the brand globally. We paid out the distributor in UK. So now we have a range of 3 white, bright varietals in terms of the Sauv Blanc and Sauvignon Blush. Yes, there's a Shiraz, but a smaller component of that in the £8 to £10 price range. So a more premium price range in UK, really good customer engagement, a phenomenal addition to our portfolio. McGuigan is the #1 product we sell in the UK, but we need more things in that market in relevant growth areas to really accelerate the business. So Madfish acquisition, we've now brought on board, and we'll see full sales of that in the second half. So, why do we believe the second half will grow faster than the first half? Is because we have a lot of this new stuff coming in and we get the full benefit of 6 months. Graham Norton, a phenomenal brand, been around for a number of years, really built over time through really good wine, great credibility, and obviously backed by Graham himself. That's a really great addition. That's a distribution deal, not an acquisition. They come into our business and we distribute and manage the brand on behalf of the brand owner. That's an example of many deals that we can do as a business and leverage our IP and our sales teams and our customer relationships. It's very profitable because I don't add any OPEX and starts to really create a portfolio of owned and managed brands that really kind of give us greater relevance in the UK market. So really excited about what that's going to bring for us. And that's coming on just this month. So a lot of work being done in and around the back. And so with these investments come a bit of working capital required to get inventory over and build a bit of backup. And so, that's really influenced or impacted the cash in the first half, but we see the full benefit coming in H2. Last but not least, in fact, not least at all, the most exciting, we've launched Poco Vino. It's been in market basically since the first half of last year, later into the half. We didn't know what we'd do. We didn't know what the scan rates would be. We had estimates all over the place. And it's actually been very exciting because the results have far exceeded our expectations and our customers' expectations. We now have Poco Vino in every single store in Australia and New Zealand. So every major banner, every major retailer. And we're seeing really, really good scan rates across all demographics. Younger, millennial and Gen Xers are all loving it for different opportunities and different occasions. And now it's about us driving that momentum and that data into the next phase. And I'll give you a little bit more color on that. The other side is Lemseco Spritz, a phenomenal growth area within wine, flavoured spritzes off the back of innovation that came through Aperol Spritz and Limoncello Spritz. Now these bottled versions of flavour and excitement are showing a more elevated RTD, if you want to think of it in that context. It's kind of if you're having a party and you want to show people and enjoy a Spritz rather than opening a can of an RTD, it fits into those occasions that require something just a little bit more elevated than just, a 4-pack of something. The differentiator with Lemseco is it's got real fruit and Prosecco, hence the name Lemseco. And we have a few SKUs now. We've got blood orange, we've got a mimosa, we've got a lemon lime coming. And so this is really about driving flavour and refreshment across the world, actually. And so a really exciting evolution of Lemseco is that we are now selling in mainland China and in mainland USA. So a phenomenal appeal for this category that is now going global. So we're excited to give the update for the full year and into FY27 of what Lemseco is going to mean for us. In addition, it's rolling out in the UK. So it's becoming a real global proposition for us. And, and as you can see by the results, being the number 2 in Australia, over a very short period of time and starting to go global, this underpins the future of the business. Both of these propositions are margin accretive. They add more profit to the business than obviously entry-level red wines, as you can appreciate. So you start to see how exciting this evolution really is in terms of the turnaround narrative of Australian vintage. So what does that look across all of our key regions? And, like I said, Australia and New Zealand, we're exceeding our expectations in terms of performance. We're growing ahead of the category, which is driven by innovation. And as you saw, even our core portfolio is performing well. The UK, we're holding in line. You can see that -6 versus -4 is obviously driven by McGuigan because we have a greater reliance and innovations now coming in H2 and into 27. So we're clear on the strategy there. We're clear on how we can really turn that over. And there's a phenomenal amount of opportunity in the UK and Ireland. Europe is still in progress. We only do about 2 million net sales in Europe, but based off the back of the appetite or the appeal Poco Vino had at Wine Paris, we're very buoyant about what Europe can bring to the business. And we'll give a full update at the end of the financial year for 27 onwards about how Europe's going to form a big part of the plan going forward. But really the exciting ones have been North America and Canada and Asia. I've been to every customer meeting. We're a very hands-on organization. We're flattening our structure more than ever. And really what they want to talk about is what's coming and what's new and what's working. And so when I talk to Poco Vino and I talk to Lemseco, retailers are really jumping at that. So we've got a very, very big expansion plan across those regions that's going to drive more growth than I think we've estimated in those parts of the world, which is a really exciting kind of outlook. I wanted to take the last few minutes just to give you a bit of shape on Poco Vino. Some of you might not know it, some of you do know it, but I always find that people kind of, unless you've seen it and interacted with it, don't really get it. And so A Little Wine is about a format innovation. It's about taking all the challenges of wine and basically solving it by going small, but going small in a way that gives people permission to engage in wine again or discover wine, depending on the market. Heaps of categories have done it successfully. Wine has fought it over time because there is a perception that small format means no quality. And that's been driven by the current small format perception. Those little wines you drink on a plane, you get in a minibar in a hotel, unfortunately do not shout premium and do not give consumers the permission to bring it out with friends or to show in social occasions that you're on the go and that wine has a role to play in those environments. RTDs let it, spirits have let it, premixed cocktails, you name it, wine has not kept up. And so Poco Vino has been our answer to that from a wine perspective. We did a lot of research on it. People said they'd buy it. The great thing is where I sit today, a lot of people have, and we continue to expand both domestically and globally. So how do you expand? Or what's the kind of driver is that economically, this is just a massive accelerator for us. If you think about a bottle of McGuigan, 750 ml sold for roughly $7 a bottle, there's a lot of effort that goes into selling something for $7 at 750 ml. There's not a lot of profit generated. There's not a lot of price inflation you can put in on it. But when you go small and you give something that people want, you can start to charge a slight premium. So for every Poco Vino we sell at $7, we actually have a multi-buy mechanic, so 3 for 15. So you're increasing AWOP, you're driving more dollars to the basket, and we're making incrementally more margin as we go. So there's lots of benefits to everyone by going small. We make more money, like I said, which is a massive part of our plan. We've got to see the profitability convert after we get the cash flow moving. And so it's got to be kind of a hand-in-hand approach. And it's disrupting the whole retail landscape, how it turns up, how it visually merchandises. We put up those FSDUs on the far right in Hong Kong, and we sold 40 units per store per week. That was 10 times the estimated volume we were going to do in one of the core Asian markets that demonstrates the appeal across the region. So obviously buyers see that, and then we start to really get momentum across a key kind of regional output. How it disrupts the store at that fixture is one of the critical innovations. Appreciate I'm at time. I won't take much longer. What else is driving it? Consumers love it. It's very TikTokable. It's very visual. It's fun. It's what wine hasn't been for a number of years. And so this is all organic reach. People are loving to talk about it and shout about it. And so we're just going to leverage that and drive that momentum. Some data points on what we've done. Phenomenal achievement in such a small space of time. Takes most companies 3 to 5 years to get these kinds of numbers. And so we're going to continue to accelerate. How? Is more product. When you've got a phenomenal success in still wine, I've got sparkling coming, I've got spritz coming, I've got different Moscatos and flavors and varietals coming, but I also have a premium range coming. This is $15 a unit. It's wines of the world coming out of premium regions. There's plenty of wine all over the world. So let's leverage that and value add that for our business. This is what global travel retail could look like and will look like in the coming years. And we've got gifting coming as well, which is a phenomenal part of liquor sales that wine has struggled to really access outside of, say, champagne, that does a great job in gifting. So what could it be? 50 million in 5 years? Pick a number, but I think we're being conservative. We're in active conversations across key Asian markets, across the USA. This is going to be big for us. But what I tend, and I tell all our current investors and new, now's the time. We're going to be turning this business around. We're going to get to the cash flow goal, get our inventory in control, and it's all about driving revenue and growth in terms of profitability. And we've got the levers to do it. So, that's the update. Any questions?
Thank you very much. I might just kick off with the first one. Obviously, this summer period, and I mean we're still in the back end of it. Key period for Poco Vino. Any learnings from, I guess, the launch here as we head into, the UK summer, which, given the amount of rain that they've had, I think they can't wait for. So, that what has been learned on the Poco Vino launch in Australia over this summer, how can that help the launch as it kicks off properly in the UK this summer?
Yeah, like I said, it's all about retail execution. So Morrison's has been in play since July last year. And Morrison's, it's the number one small format across Morrison's now. Why? Because where it's executed right, together, you can see that visual disruption either on shelf or in a freestanding display. If it's executed correctly, Poco Vino works its socks off. Where it's not executed well, standing upright next to a cash register, we've got independents in Australia that, choose their own adventure. It doesn't perform as well because you don't know what it is. So you can't get to it as quickly because it's not a known brand yet. So the key learning is about execution. Where we execute and engage with retailers well, it performs. And so that's been now the focus as we roll out to Sainsbury's. We're going to be rolling out to, across the UK retail landscape now for the summer. That's going to be the critical deliverable.
And in terms of the managed brand strategy that you're undertaking now in the UK, is there further conversations happening around that? To bring in a few others, and the follow on then does it work in reverse? Would you manage brands either already in market or looking to access the Australian market? Coming from France, America, South Africa,
Sure.
wherever it might be.
Yeah, I mean, you get the sense of me. I'm talking to everyone. I think this industry lacks a little bit of collaborative discussion, both from a back end and a front end perspective. I think there's been a lot of kind of holding cards to chess, but there isn't a lot of IP. There's a huge amount of duplication. If you look at, say, Vinaki, who has come together, Pernod Ricard accolade, they've got 160 brands, so they've got the inverse issue to us, and yet they talk to all the same retailers we do. But we've got now 4 major ones that we can discuss. So you start to see how if I layer in the right portfolio mix on either a distribution, acquisition, or innovation perspective, we've got plenty of bandwidth to go. So yes is the answer. We're in discussions. Whether they materialize or not, I'm agnostic about, but we'll remain open on both wine and brands as we kind of go forward.
Okay. We got a question here, and just a quick comment on the debt levels, and I guess how that is progressing. As you say, it's only kind of a point in time, but how we should think about it as we go through like another 12 months now, and season upon season starts to kind of pile up, and the stock and cash flow comes into the debt piece.
It's a great question, and what I'd give comfort to any investors on this call is I have spoken to everybody. I love talking to investors, analysts. I get insights on things that maybe I wasn't across, but most of the time it reinforces the strategic levers that we're focused on every day. And so one of those is net debt and debt total levels. The problem with our business is we have very chunky cash flow months. So when we buy our grapes in the first half, we have a high cash out half, and then we get the benefit of the cash in H2. And so the half year is never a true reflection of kind of the total ordinary operating cash flow of the business. It's kind of a peak. The good thing is going forward, we don't see the need for any more creep in terms of our net debt going forward on an ordinary operating basis. If Pocovino tomorrow goes gangbusters in the US, yeah, I might need some working cap, but that's a different dialogue with funders and with our bank partners. When you're talking growth and acceleration and high margin products in new markets, that's different to the history of AVL, where we were funding great procurement contracts that were going into inventory, through our debt facility. That's not a sustainable business going forward, and that's what we've absolutely stopped. Hence the first half investment in exiting one of our leases, so Milawa. We got out of that because we don't need those grapes. So it's cheaper for me to buy the exit than it is to take the product going forward, because it frees up cash, gives me ability to invest that now back into the business, into things that generate a decent IRR. And it allows me more flexibility to buy variable wine, which actually gives me a profit benefit going forward. So this is the turnaround year. I am laser focused on net debt. And we do estimate long-term that will, of course, tail off. And then the goal is to start paying that down, or we grow faster through the top line and through the profit line, that we just continue to fund the growth of the business as we go. So, that's a focus, and that's, we were pleased that we hit the number on the half that we guided. It should have been better. We had some retailers pay like 3 days later, but, I'm agnostic about that because the cash came in, obviously. But we're really focused on that for the full year.
Just on Pacavino, I mean, there's the current ones in market. You said, there's a whole load of more SKUs that are going to come online, let's say over the next 6 to 12 months. That is kind of maybe a slightly different challenge that than Australian Vintage had in the past, of so many SKUs, so many different varietals, and if you get one going gangbusters out of a mix of 12, how are you planning on avoiding stockouts, or managing the variance in volumes and demands for all the like different types of SKUs? Maybe just touch on that.
The great thing about our business is we do a lot of wine. So Poco Vino, as it's growing, I don't have any issues supplying one SKU up or one SKU down. That's the good thing about a startup wine brand in a big wine company. The other insulation is that in every market I sell it, I source the wine from that market. So if Europe goes nuts, I source it out of France, I order it on a day, it arrives a week later, and all the working capital has been borne by that company, that wine company, storing and managing that wine. So it converts to cash much faster than our current inventories do, because we've got to hold wine for a year or 14 months. In the US, which we're going to go live in the next 12 months, it's Californian wine, localized. So, what you start to see is Poco Vino is even breaking the rules of global wine companies, because I refuse to be anchored in one place selling to the world. You think about all the shipping chat delays and costs and geopolitics and environment. So Poco is insulated from that, but we're very lasered in on, as this thing continues to grow, yes, sourcing matters, but I only need for one bottle 187 mils, not 750. So the growth doesn't dramatically hit into millions of liters. Hopefully it does, and I'll be ready, but that's in the next 2 to 3 years.
Yeah. Okay. Perfect. Tom, we're bang on time there. Thank you very much for coming in and giving us an update. And yeah, we'll continue to follow the story over the next 12 months. Thank you.
Thanks, Mark.
And we will move swiftly on to our second presenter. Josh Simons from VNL Group. Josh, good morning.
How are we all?
We're very good, thank you. Josh is here. I can see by the cover slide of his presentation, talking a little bit about the result, but probably the more updated.
Can you see my screen there? Is that all right?
It is. It's perfect. I was saying probably the more pertinent thing to talk about is the acquisition that was announced at the start of the week. So I'll let you take it away from here.
No worries, Mark. As you say, I expect probably most companies today to be talking about their first half financial results, but we're here to talk about a really exciting milestone in our company's history. So let's dive in. On Monday, we announced that we entered into a binding agreement to acquire the assets of Val Morgan Digital. Val Morgan Digital is the publishing arm of Val Morgan Group, which is a subsidiary of Veitch Group. Val Digital's assets include key partnerships and licenses in Australia and New Zealand with BuzzFeed, Fandom, Lad Bible, and Vox Media, so pretty recognisable brands there. Val Morgan was actually a former competitor to our publishing arm, Vinyl Media. So this acquisition will significantly expand that portfolio that we have of cultural assets, and importantly, it will increase our national audience reach to be comparable with Australia's largest media organisations, including Nine and News Corp, which materially strengthens the scalability of what we're doing at Vinyl Group. The acquisition price was $10.5 million, which comprises of $7 million in cash and $3.5 million in shares, which will be funded through a facility of up to $10 million provided by our existing shareholders to fund the cash consideration and some additional working cap. Val Morgan Digital delivered revenue of $10.7 million in calendar year 25. So the consolidated revenue of our Vinyl Media division will increase by over 70% as a result of this deal. Val Morgan Digital is expected to deliver a pro forma annualized EBITDA contribution of $2.5 million post-integration. And in addition to the asset sale itself, Vinyl's also entered into a separate cooperation agreement with Veitch Group to cover outdoor and cinema advertising cross-sell capabilities. Also announced on Monday is that the Veitch Group CEO, Damien Keogh, will join our board of directors following completion. Damien's had about 25 years of senior media commercial leadership experience, and he will support the smooth integration of the businesses. He's also a hell of a basketball player. As I mentioned, the acquisition significantly expands our portfolio of cultural assets. So what you see on this slide here on the left is all the platforms and publishing assets of Vinyl Group as it stands today. Right is all the publishing assets of Val Morgan Digital and what we stand to acquire. These publishing assets are a combination of owned and licensed properties, and we're responsible for content creation and managing ad inventory depending on the terms of those individual licenses. These assets are what we are calling our cultural landscape, and we're increasingly seeing that we are becoming the acquirer of choice for international cultural asset owners or subscale operators. The second key component of this acquisition is that our combined audience of Vinyl Media and Val Morgan Digital, it achieves a national scale across Australia's news and entertainment categories, which you can see sort of on the table here on the left side, the entertainment column. Google, obviously Alphabet at the top there with 96% of internet reach in Australia. Then Spotify and Apple sort of second and third, close to 60% audience reach. And the consolidated vinyl combined audience now sits at 47% in those categories. So this means that we can access nearly half of all Australians over the age of 14 who are active online and seeking out entertainment. In the news column on the right, you can see News Corp at the top there at 63% and both Nine and ABC at 55%. And then our consolidated entity, our combined audience is sitting at 51%. So it is important probably also to note here that this data, it's third party, Ipsos Iris, independently verified, and this is the industry standard for measuring audience reach. It's what advertisers also use, and everyone in the industry will have access to the same data. So you can see that we are now viewed, or will be from now on, as a large and fast-growing media organisation with national audience reach. And that's extremely difficult to replicate, and we believe that it will give us a real competitive advantage moving forward. Which brings us to the exciting part of this deal for me. If we think of the cultural assets and the national audience reach as the sort of foundations, then adaptive media is what we can do now at scale. And as you can see here, we are ushering in a new era of adaptive media, which is cultural outcomes, not just content for advertisers. Adaptive media, it's an integrated advertising model where cultural assets, technology and distribution work together to deliver meaningful brand connections, again, at scale for the first time. With Vinyl Media, we've been doing this for a while, but this acquisition enables us to scale rapidly and offer a compelling value prop to advertisers. This presentation was, of course, released to the ASX on Monday, but in parallel, I've been talking with industry partners about this new adaptive media concept. And the initial reaction to it all has been extremely positive. Everyone understands that this industry is evolving, and we are just formalizing or putting a name to changes that many people are becoming familiar with, and the tide is certainly turning. We think we're leading that. We believe that adaptive media delivers better outcomes for advertisers. I think everyone here will be familiar with legacy media, which is predominantly sort of, we're talking about broadcast TV, radio, newspaper. This gave advertisers, a mass audience reach, but it didn't really bring with it that niche targeting or meaningful brand connections. The cliche from the olden days of the whole family sitting around and watching the news or entertainment on one TV and seeing the same ads, it just rarely happens in the modern world. Then comes along social media in the early noughties, and it's sort of, these are more platform, they're algorithmic-based targeting, which gives advertisers better ways to target niche audiences, and they can do this at scale. But the advertising, it's still interrupting or interrupted by nature, and it interrupts that sort of content experience. So as you scroll, you're interrupted by ads. And it may be better targeted, but you probably won't develop a meaningful brand connection as a result of seeing an ad on a social media platform. It's relatively passive. Which brings us to adaptive media, which is, we say, embedded in cultural assets. And this gives us that holy trifecta of mass audience reach, niche targeting, and meaningful brand connections. It's cultural, participative, and immersive. Now, on this slide, we sort of show the key issues affecting ROI on advertising spend across these three channels. Legacy media, as I say, can deliver that broad brand awareness, but the audiences are fragmenting, and there's now lower viewership for those aged under 40. Social media can deliver cheap brand awareness. However, the ad feeds are interruptive. Micro-targeting is now more regulated than ever. So adaptive media provides advertisers meaningful brand connection through a mix of these distribution channels, but in an integrated and immersive ecosystem. And this together delivers a higher ROI on ad spend. As I said before, we're already doing this, although we didn't call it adaptive media at the time. So this is a case study of the Mentos Fresh Sounds campaign that we designed and executed last year. Our goal was to create a multi-layered discovery platform that positioned Mentos as the true champion of new Australian music through the Fresh Sounds campaign. And it's important to note here that adaptive media campaigns, they're distribution agnostic. Well, what the hell does that mean? So the campaigns utilize both existing channels, so legacy, social, and emerging channels, AI, cultural assets, native content, to target niche audiences at scale. Now, we created a dedicated campaign website in this instance. We hosted a live event. We created some content in collaboration with music creators. We added our own editorial and social content through our landscape of assets. We created a video series, facilitated some sponsorship of cultural events. These are the sort of modular components that come together to create an adaptive media campaign. And hopefully you can see this sort of working together in that immersive and integrated ecosystem, as I say. You can't do this with legacy alone. You can't do this with social media on its own. You need all of these components and you need that audience participation in order for this to work. Now, this campaign was an overwhelming success and exceeded expectations across all metrics. This slide here breaks down the competitive landscape with brands and companies that you'd be familiar with, and to show you how we're different and why we're providing different value proposition for advertisers. Now, the great part about this model, like all network models, is it has a self-reinforcing momentum to accelerate scale. We start at expanding ecosystem, which is the vinyl acquisition with Morgan Digital, combines our premium cultural assets into an integrated and immersive ecosystem, utilizing all of these distribution channels that we've covered. These assets then lead to a growing audience, an increased national internet reach, and we maintain viewership through our premium content, unique publishing assets, and technology-enabled best practices. Now that we have that expanded ecosystem and a growing audience, we then attract brands who want to access that ecosystem, and we become a more compelling option for advertisers, particularly those who want to target that youth or younger demographic. Then we deliver superior ROI for advertisers through the adaptive media campaigns. And the key here is that the value of the ecosystem compounds with every successful campaign. Then this leads to acquiring more assets as we become the acquirer of choice for premium cultural assets. And the flywheel keeps turning and that positive momentum continues and the business scales. This adaptive business model is defensible across a number of variables. Firstly, it's hard to replicate. You need scale to be profitable, and it requires technology as a core capability. Also, it requires both mass content and bespoke custom content creation capability, two ends of the spectrum. Social media is a small component of adaptive media campaigns rather than a direct competitor. It's not platform dependent, and we believe that this will become increasingly important for advertisers as platforms get more power and extract more value for themselves, often at the expense of the stakeholders using the platforms. Finally, it has a self-reinforcing flywheel effect, as we've covered, where consumers, fans, and creators or brands all win as the ecosystem grows. Now, as mentioned earlier, as part of the acquisition, Damien Keogh will be joining the board. Damien has been the CEO of the Hoyts Group since 2014, and he previously held roles at Channel 7 and Foxtel. He's an experienced media executive, and we're extremely happy that he is committed to vinyl and that he'll be joining us on this exciting next phase of our growth. Looking at the financials, you can see our revenue trajectory in blue over here, going from around 25 million in FY26 to nearly 40 million in FY27, and also taking us to an expected EBITDA positive position by FY27. The FY26 full year results will only include one quarter of the Morgan business, so we won't see the full impact of this acquisition until the next financial year. In terms of upcoming catalysts, we're focused on scaling the business. We expect to see further expansion of the cultural assets via M&A in Q3 and the integration of these assets in Q4 of this financial year. In the second half of the calendar year, we'll be looking at relevant technology acquisitions to further enhance the flywheel. And beyond that, we also have an eye on global growth potential, and we'll take advantage of any opportunities to accelerate that, of course, where appropriate. So in summary, the acquisition of Morgan Digital is transformational for vinyl as it materially enhances our scale, it accelerates everything, and consolidates our position as one of the largest and fastest growing media conglomerates in the country. And over the months ahead, we'll be focused on that integration with another eye open to technology-based M&A. On that note, I'd now like to open up for any Q&A.
Thanks, Josh. Yeah, very exciting coming together. I think I know it's an acquisition, but given Damien is coming onto the board and they're taking script, I think it's very much more of a kind of a partnership rather than a straight one-off transaction. Okay, we're buying this, they're letting it go, kind of thing. So I think very exciting acquisition.
Mark, that's how I tried to structure this one. The assets alone were interesting, but the prospect of doing a deeper partnership where we can sort of tap into some of that cinema network, out of home network, bring Damien in, help really nail that integration piece as well. Having done several acquisitions now in the past couple of years, those were all important features for me to push for rather than just settle for a simple asset purchase.
And then just if we can just talk about the integration piece, is this more about obviously you're getting all the new banners in there. Is it more about the synergies rather than is there like kind of costs out that come from having the bigger scale, or is it maybe a combination of the two as you work through the integration, over the kind of balance of calendar year 26?
Well, the scale commands a few things. It commands minimum, certainly in theory, minimum commitments from brands, or at least the companies that brands use to decide how to spend their marketing dollars. So having that scale and having this number of cultural assets all in one home just gives us a little bit more leverage than we had before in that respect. So in theory, the effect of more than just 1 + 1, right? Because you bring that revenue over, but you're also getting this new defensible sort of bargaining chip that perhaps neither company had on their own. So that's sort of number one. Number two, there are certain functions inside of these businesses, certain teams that there's no requirement to have double up. So some element of redundancy in a merger like this. So there's a saving to be realized, and we've sort of quantified that in this presentation, in the announcement, and sort of pointed to a $2.5 million number there. So that's sort of your saving. As for the compounding effect of those two things working together, we've obviously provided some guidance for the first time out to FY27. But we'll, we're not a company that sat on our hands for the last 2 years. We've been quite aggressive in our growth strategy, and I think that's probably a worst case scenario is what we've painted here.
Got a question on further acquisitions that you touched on just at the end of your presentation. Given proposed path forward in acquisitions, do you feel with the backing of the major shareholders that you have unlimited capacity, our questioner says, for ongoing acquisitions? So I think I think maybe the question is, with the further acquisitions, is there kind of anything size-wise that might be a bit off the table, or are you kind of free to look at anything that would be additive to the business?
I think we need to deliver on what we've already bought before we go out and start throwing around, even bigger ideas. So I don't think it's not a blank checkbook by any stretch of the imagination. It's important to our shareholders who have gone on the record and said as much, that we show we can operate, and I think that's what we tried to demonstrate through the last several months. Is my video off? Sorry.
Yeah, it is. I think you just knocked it with your hand there, Josh. You're back now. No, it's okay.
Okay. Sorry about that. Yeah, so I don't think there's no unlimited checkbook. We have to demonstrate that we can continue to be good operators, and that's what we frankly did through much of the last 12 months. We haven't really bought anything. We've been proving that we can deliver on the assets that we already had. We obviously had our first cash positive operating quarter in December, which is a really important milestone that we'll seek to build upon. We're in a transition year at the moment from being a loss-making company to a profit-making company. So this will accelerate that. And I think, like always, once you can demonstrate that you we can see that sort of mission through, and that you can nail the integration, then I think people start to go, okay, we'll look at opening the checkbook again. But I never take that for granted. I never have, and I never will.
Just in terms of the adaptive media model, and given the size now, when you bring the two businesses together, I know you said the kind of minimum requirements for an ad campaign goes up, and that's helps revenue, and you get a bit of operational leverage from that. But does it open the adaptive model? Does it also open up conversations with brands that you kind of haven't worked with before? Because even with all the previous assets, now with so many more assets, actually does open up campaigns that you couldn't execute on before, or brands you couldn't execute on. I'm talking, big national brands are doing stuff with government, even if that is something they want to do. Does it open new doors, as well as just increasing ticket sizes?
So I'm much more interested in the opening of the new doors and increasing the ticket sizes. Increasing ticket sizes doesn't always lead to better outcomes. It can be higher COGS and all sorts of complications. This is it's an astute question, actually. This should open the door quite dramatically, because if you look at the total size of the ad market in Australia, we're talking about what was previously sort of relegated to, let's call it native content, might have represented about 15% of the total ad spend of all brands. What we're saying is we're doing that much bigger, more impactfully, and our objective is to claw some of that money that's currently going to social legacy back, so that we're actually not necessarily increasing the pie, but we're readjusting that split, and how that spend is apportioned. So yes, I absolutely expect to see, just by virtue of there being less players in the market, more of that, more of those briefs coming our way, and then our job is obviously to win those briefs and convert that into revenue for Vinyl Group.
And the adaptive model, does it allow you to kind of charge a bit more of a premium as well? Because as you talked about there, maybe some of that like user generated content coming in and building the community, like the brands know that they're really talking to their like kind of ideal customers, or the ideal people they want to chat to about their products, about their services, but in a more holistic, even community focused way. I know community is a big thing now in the marketing world, because brands have like realized, running clubs exploding because Nike, Adidas, all these guys realize it's not about like selling the shoes. You can actually sell more expensive ones and more of them if you like deepen the relationship. And I think the adaptive strategy seems to be where you can get brands to pay more, because you can actually get that kind of closer integration with their customers.
Yeah, you're trying to sort of sell almost an affinity to the product, right? The short answer is yes. So the magic, Mark, is like, how can we're not going to match the lowest of low CPMs, but we're not trying to, because we've got all those things you just mentioned. So we're not going to compete against TikTok for 30-cent CPMs or whatever. We're going to be charging much higher premium, $10, $15, $20, depending on how the campaign's put together. But what we can do with scale and with this position in the market is we can start to lower those a little bit, so that we actually can compete on some of those items, relative to older models. So that when those brands are making those decisions, that yes, they can look at all those very nice things that you described then, but they can also look at the unit economics and go, it competes on that level as well. That's what scale affords.
And if we were, I know we briefly touched on acquisitions there. Is there anybody internationally doing this, adaptive model? Is there a UK business, a US business, who've kind of gone down this road ahead of you, that people could kind of look at, what can kind of be achieved once it's kind of matured, if I can say that?
Well, some of the publishers or groups that we license items off are already doing a version of this in America and the UK. The challenge that they'll have in those markets is that they're much bigger. So if a key ingredient is sort of having saturation of cultural brands such that you can get competitive on CPMs and briefs and all those things we've just discussed, it is harder to achieve that without spending significantly more money to acquire or accumulate all the assets in those bigger markets. That's what makes Australia quite unique as a testing bed for this new model. I see it as a tremendous opportunity, because if we nail it, and it's something that people start talking about, we're really sort of leading from Australia for the world. As far as are there other opportunities out there to expand this globally? Yeah, the short answer is yes. There's, particularly in parts of Southeast Asia, little agencies that would do a version of this, not call it adaptive, not have the titles, not have the licenses, but offer the services and understand the local lay of the land. So we'll keep an eye on businesses like that as we think about global expansion.
So they're doing adaptive, but without holding the assets. They're kind of project managing, pulling it all together for the brands, but without being as vertically integrated as Vine. Am I understanding that correct?
Yeah, that's correct. Yeah.
Yeah. Okay. And in terms of something you just mentioned at the very start, the cross sell with Heights on the outdoor advertising and stuff. Maybe just touch on how that's going to work. Is it a kind of a two-way flow of traffic? You'll kind of send stuff their way when it makes sense, and they'll obviously open doors and send stuff your way. Is it as simple as that? Kind of a quid pro quo. There's no actual revenue or introduction fees or anything like that to go with it.
Well, there'll be a revenue share, based on the terms of the individual contracts that are thrown either way. But what it does on a very high level is it gives our sellers the capability to work with their team on certain briefs to expand what we're able to package together. So that we can include some out of home, so that we can include some cinema, and vice versa. They're obviously running a massive business there on their screens, and they get campaigns probably from many of the same agencies that we deal with, frankly, that want to really only work with one provider. By doing a deal like this, they can access our inventory without needing to compete, and obviously there's restraints in there anyway. But the point is both sides can sell expanded offerings and be that one-stop shop for agencies and brands, so that they don't have to deal with multiple service providers. And obviously there's commercial splits that happen behind the scenes to make sense of all of that.
I mean, that's an interesting point. Maybe the broader industry, since the deal got announced on Monday. I mean, if you're the agencies working with these big brands, sending out pitches, I mean, what has been their response? Have you heard from anyone, or what do you think their kind of response to this deal will be?
Well, we're going to do a roadshow once it's complete, because I think doing a roadshow before it's complete is extremely assumptive, not to suggest that there's any risk of it not completing, but I'm just maybe it's the Englishman in me. I like to wait until things are formal and proper,
Yeah.
and then we'll go out and do the rounds. But of course, everyone wants to chat now. It's been a big news story in the little bubble that we exist in, and everyone wants to have a chat. As I said in the prezzo, it's the response has been fantastic. I think there's probably some skepticism too, frankly, but that's our job to really sell that into the market. And we love a good challenge at Vinyl, so we'll get on with that. And I'm extremely pumped up to hit the road and go speak to all those agency partners and brands and start selling adaptive media into the second half of the year.
Yeah, don't tempt fate. And just on the wrapping up and the last, dotting I's and crossing T's. I don't remember from the initial announcement, but there's no, given size of the market, you said you're going to have one system. There's no ACCC issues or anything here that needs to get regulatory approval, correct? Just to confirm.
No, we did. That's a great question. Again, we did get an opinion on that, and no, there's no ACCC concerns with respect to this.
Okay, so that doesn't need to. You don't have to hang around and wait for that regulatory approval to come through, which should speed
No,
up
it
the.
typically affects businesses with turnover in the hundreds of millions, which we hope to be at soon, but we're not quite there yet.
That just helps to speed up the last bits and pieces. So with that, estimating it in before the end of April, May, would that be fair to say? 3 months from now?
Estimating what, sorry?
The formal completion of the whole, when the numbers are actually going to start coming in.
Oh, we're targeting an end of March completion, so we're working pretty
March.
aggressively behind the scenes through the rest of the month to get this done, get it integrated, and as I said, get out there and start selling. So yeah, but both sides are keen to get this completed.
And the script piece from is that going to be held by Hyatt's, or is that going to be held as part of the broader Valmorgan group? I'm just trying to understand who's actually getting the shares from that.
Well, Hoyt owns 100% of Valmorgan Group, so
100%. Okay.
Yeah.
Okay, perfect. Josh, we are just coming up on time, so we'll leave it there, and good luck with the wrapping up everything and the post industry roadshow when it comes around, and we'll hopefully have you in for an update at some stage during 2026 on how it's all going.
Absolutely, as always. Thank you, Mark.
We still have to get you back for the victory lap. We thought it might be now, but we
didn't do the victory lap in December when we got cash positive like we said we would. So now
exactly.
we've just done it. We've just done it.
Just done it. Okay, we'll leave it there. Thank you very much.
Thanks.
And if I could just ask you to please stop sharing your screen, and we will hand over to Brendan Malone, who I see has been waiting patiently in the wings there. Brendan, good morning.
Good morning, Mark, or good afternoon, Mark.
Good afternoon. Sorry, you're right. We are past midday. Thank you very much for coming back to give us an update on
you can
half one.
See my screen?
I can see your screen. You can take it away whenever you're ready, Brendan.
Brilliant. Thanks, Mark. And thanks, Mark, and Coffee Microcaps for hosting today. My name is Brendan Malone, Managing Director of RAIZ Invest Limited. It's been a pretty exciting start to 2026 for the company. On the 10th of February, we celebrated our 10-year anniversary. And on the 27th of February, we released our half-year results for FY26, which delivered a huge milestone as we transitioned to structural profitability. And I'll just give a bit of a background of why RAIZ and where we are today. When RAIZ Invest launched a decade ago, the idea you could invest your spare change from everyday purchases or build a diversified portfolio from the palm of your hand in your mobile phone sounded bold and pretty unconventional. But we created RAIZ to solve a problem. This concept struck at a simple truth. Wealth creation should be accessible to everyone, no matter their starting point. So 10 years on, that belief has only grown stronger. What began as a micro-investing platform has evolved into a broader behavioural-driven financial ecosystem. Through roundups, automated investing, RAIZ Kids, RAIZ Rewards, RAIZ Property Fund, and our own RAIZ Invest superannuation, we've helped Australians build confidence, build habits, and build futures one small step at a time. But more important than just the innovation is also the impact we've had out there in the market. RAIZ has empowered a generation that traditional finance companies overlooked. Younger Australians, first-time investors, families who simply needed a place to start. Our customers remind us every day why financial inclusion matters and why we do is meaningful. So just to talk very quickly over the 10 years, and 10 years equals some big numbers. We've had over 1.7 million Aussies sign up to the app. We've had over $5 billion. That's $5 billion has been invested through the platform, with over $233 million reinvested from dividends and distributions, which would be a lot of Australians. It's the first time they've ever received any sort of dividend or distribution like that. We've had over $744 million of roundups, and we've opened up over 149,000 RAIZ Kids accounts. And then on our RAIZ Rewards platform, we've provided over $9 million of RAIZ Rewards or cashback offers reinvested on behalf of our customers. So those numbers are pretty big after with the impact that we have. But jumping into our first half FY26 results, as you can see on the screen here, we've got close to just short of 340,000 active customers at the end of January, and we have $2.13 billion of FUM sitting on the platform. We've won numerous awards for innovation, as you can see there, which we're very happy about getting the industry recognition. On to the first half 25/6 results. Strong revenue growth driving improved profitability. The arrows are all pointing in the right direction. Revenue is up 24% with our underlying EBITDA up over 270%. Importantly, our operating cash flow, which is our operating cash from continued operations, net of CapEx, was up 51%. And cash at bank is up 17% to 14 million. On the core business side of the drivers that we look at in the key metrics, our customer numbers at the end of December were 336,000. As I said on the previous slide, we're up to 339,000, 340,000. So we've continued to see growth there. Importantly, our ARPU, and as I go through the presentation, you'll see that we do put customers at the heart of our operations, but also we want to be able to put the right products in front of the right customers, and that's what's driving ARPU there. It's up 16% year on year to $86.45. Over $2.1 billion of FUM, that's up 29% over the year, with net flows, so that's net inflows coming into the period of 138 million, or up 30%. We also reaffirmed our guidance from our FY25 results with our underlying EBITDA in the range of 4.5 to 5.5 million. As we talk about our drivers, the two big key drivers for us is our active customers, and you can see there that there's been over 5.4% CAGR over the last 4 years, but importantly, over the last 12 months, we've had a compounding 5.7% growth in customers in the last 12 months, and then our FUMs continue to grow, and that's a combination of both our retail fund, but also our superannuation fund to just shy of 2.1 billion. The strong growth in ARPU, as I said, we put our product offering and our best interest of our customers in front of them. We build products, and you'll see on the next couple of slides the innovative products that we're doing, but we continue to solve what our customers need, and that's a big contributing factor to the ARPU growth. We want to get the opportunity to cross-sell and get a better share of wallet from the revenue of all our customers. The ARPU was up 16% with a CAGR of over 13% or closer to 14% over the last 3 years. There was one of the big factors in the last 6 months was a fee increase. On the 1st of August, we put all our portfolios up either $1 or $2, depending on the portfolio. And I'll just pause there to explain the revenue, and the bottom graph sort of shows it there, the drivers of ARPU. Our main revenue source is what we call our maintenance fee, and that can be, depending on your portfolio, $2.50 a month, $5.50 a month, or $6.50 a month. If your account balance goes over a certain, if you're in a certain portfolio and you go over a certain threshold, 25,000 or 28,000, we move to a funds under management based fee. And that sort of sits around 60% of our revenue comes from the maintenance fee, and about 20% comes across from the fund-based fees. Obviously, our goal is to drive that fund-based fees even higher. But with that 60% in maintenance fees, 20% in the fund fees, but also there's 15% of our revenue comes from our advertising stream, which I'll get into a bit later, and then 5% from both interest and our netting profit. So it's a nice diverse range of revenue coming in there. The business is built on particularly 3 core pillars. As I said, exceptional customer experience. We put our customers at the heart of everything we do. We listen to our customers. We build the products. And as we go through to the next pillar of innovative, impactful products, the beautiful part about the RAIZ model is we are building products that our customers are asking for. So we're not an organisation where we build a product and then have to go and gather customers. Our customers are asking for it. So we're delivering the right innovative and impactful products there. There's some exciting features coming up, which we'll run through in a minute. But off the back of that, it's like, how do we grow our customer base? And that is through trusted partnerships. Yes, we can acquire customers on social media like we always do, but how do you deepen those relationships? How do you grow the customer numbers? And it's a combination of new customers, but putting the right partnerships in front of them so that our customers either come back to us or we get our new customer acquisition as well. On the exceptional customer experience, where obviously AI is very popular, and if you look at the name RAIZ, AI is in our name. We've been using AI for 10 or 11 years now, but we're really going to focus the next 6 months on our customer experience and driving a better customer experience, and that's what's going to differentiate us from our peers, to make sure we can do it quickly, securely, and appropriately for the right customer. We've got a couple of initiatives there with the digital onboarding, some enhanced RAIZ rewards, putting the right message in front of the right customer, and then also taking it to the next level and helping our customers out quite easily through a personalised coach. As I said, putting the right products in front of the right customer. On the 1st of August, we moved to a plan type structure, where we have a light product, a light plan for $2.50 a month, a regular plan for $5.50 a month, or our plus plan, a bit like a Netflix exercise, where we want to push customers up our value curve, and we do that through through putting different products and the more relationships we have with our customers through not only our active customers but our active portfolios. And you can see there that we've grown 17% over the last 18 months. So what that means is that customers are having more than one product with us. I think by talking about the right products, our customers told us they would like a kids investing opportunity, and you can see the growth, or 109% CAGR in FUM over the period, but also our plus range, where our plus portfolios is an exercise where customers have come into our passive portfolios. We've educated them on financial investing. They go off and say, oh, now I want to do it on my own, and they can create and build their own portfolio with about 152 investment choices, and they can create and weight their own portfolio, and that's the top tier. And you can see both the popularity, but also new customers coming into those products. They're choosing the plus plan as their first plan. I think that's grown to about 38% on day one portfolio. There's just a real quick snapshot of the products that we have, and as I said, we want to get everybody to use all of these customers so that we can improve the relationship with our customers. But these are the award-winning innovation that we've developed over the last 10 years. So some key priorities in the ambitious roadmap for 2026. What we're going to be doing now is, I talked about the revenue streams, and that's a recurring basis. What we're doing now is moving into, well, what else do our customers want to, what do they need and what do they see? Where do they want to use our products? And that is moving, not only the instant payments is a bit more of an efficiency exercise to make it faster and real-time trading capabilities. So we need to build that first before we go into direct ASX listing, ASX trading of the whole ASX through single HIN, and then into the US listed equities, because a lot of our customers, they're young millennials, they're playing on their Apple phone, watching Netflix, and then want to buy either Nvidia, Apple, or Tesla. So we're going to break down the barriers to get all Australians access to that the US listed space. And what that does from an investor point of view, it improves the customer life cycle value chain or value opportunity there by keeping them in the app, but it also diversifies into a transactional based revenue. So we've got our recurring customer base over here, or revenue over here, and now we'll start getting transactional revenue, which is quite exciting. As I said, the third pillar was our trusted partnerships. So we're starting to get some really good names on there. State Street is an investor in RAIZ. We had a placement with them nearly 18 months ago. They're continuing to work with us on our product development and roadmap, which is quite exciting. We announced about 3 or 4 months ago the KFC partnership, where the KFC employer choice for saving and investing, so that they can educate their employees. We've got some long-standing relationship with Channel 7. We're doing some great stuff on the data and insights through their Phoenix project, and we're about to kick off a partnership with Year 13 in April that's got over 2.5 million young Australians signed up to their platform. Jumping into the financial results, I won't spend too much time on this, but as I said, the revenue is up 24% to 14 million. What was very happy was the growth in the revenue compared to the growth in our operating expenses, which were up a modest 8% year on year. And then falling through to the bottom line. And I think what came out of our FY25 results into these half-year FY26 is the scalability and the leverage that we have. We've got multiple levers for growth, and that does fall through to the bottom line. So we're very impressed that we've transitioned to the structural profitability, which is a huge milestone, as I said, for February. There we are. There's a quick underlying EBITDA graph just to show you the waterfall and how to get through it. And obviously there's a $2.6 million deferred tax sitting there for our bottom line NPAT. We talk about cash flow. It's important for us as a small company to make sure that we're well funded for growth and we use our cash appropriately. And I think over the last few periods, you can see that we've got positive operating cash with a free cash flow, which includes the CapEx. CapEx was slightly down on the year before as we start to use and improve on both our technology stack and the use of AI in the back of house, not just for our customers. So the outlook, as I said, we've got two levers. We've got multiple levers for growth, and one of them is winning new customers. And you can see there, it's an old survey from the ASX from 2023, but RAIZ has about 340,000 active customers. There is 1.3 online, 7.7 investors holding listed investments. So there is a huge opportunity for one of our channels to acquire new customers, but also on the other side of this slide, we've got a re-engagement and a cross promotion where we do have 339,000, and you can see how many use kids, how many use plus, how many use our jars, RAIZ rewards, and super users. So there is a huge opportunity to strengthen and deepen those relationships with our existing customers. And we've got two awesome guys in the two awesome team members in the marketing, one focusing on new acquisition, one focusing on that re-engagement and cross promotion. When we talk about what the value chain and the value opportunity is, this is what we're building. We want to actually be a part of every Australian's from cradle to grave's life cycle or their financial services journey. And this is just a diagram to sit there and say, if you look at it, we've got 75% of our customers are millennials and younger. So we will have those going forward. So there's a huge opportunity to deepen the relationship and improve the revenue from those guys. But you can see there's 5% of our customer base of boomers, so they are using it. You know, my dad uses RAIZ Kids for my daughter. She's in the kids count. So as that generational moves, and also we talk about the intergenerational wealth transfer, this is going to be a part of it. We want to keep it in the ecosystem. So we continue. You can see the yellow and the orange are the new products that we're going to get released in the next 6 to 8 months. Going back to our pillars, there's a couple of points there on each one on how we're doing and what we're doing for our to maintain and stay steady on those pillars. I've sort of covered off what innovation's coming, but there's lots going on, and we're quite excited about the next 6 to 8 months. And then why invest in RAIZ? It's a compelling investment thesis, and as I said, it was a big milestone to move to structural profitability. But yeah, we've got steady revenue growth. We've got a proven model here. We've got a proven delivery over the years on our product roadmap, and we deliver on what we say we will deliver on. We've got a proven track record of our disciplined cost management over the last couple of years, and reporting periods, you can see that we're delivering on what we need to deliver on. Our tech is scalable. We're a digital first platform, and people ask me, well, how do you know it's scalable? We've had independent reviews of our technology stack, but also too, if anyone knows the history from 10 years ago, we came out of Acorn's Grow in the US. So we're based off their tech stack. It's our own independent tech stack. We own it all, but they've got over 4 million daily users and about $6 billion of funds under management. So we know the tech's there and we're continually improving it. But we have that strong operating leverage. If you go back to the margins and the underlying EBITDA margins, we had a great second half last year, which you can see the scalability is dropping through and the operating leverage drops through to these half year results. And then more importantly, we've got a solid funded with a great team on board, great management team, and an even better staff. So, Mark, I'll leave it there. I'll leave that screen on, and I'll send it back to you for any questions.
Thanks, Brendan. Maybe one question I had was, and you did slightly touch on it in one of the graphs there, but given some people have been with you maybe the whole 10 years, but that cross sell of the products, where you had the opportunities for kids jar, sorry, yeah, that one. I mean, are you tracking, or is it a metric you look at? How many products somebody is taking up? So they've got jars, they've got a kids, and they're using rewards on a regular basis. Like, is that trend line going up of having multiple products rather than people just using it for the kind of spare change issue, and maybe a jars for some kind of savings plan as well?
Yeah, look, that's a good question. And look, I know we can do better cross-sell, and you can see the opportunity on this screen here. But if I just pop back to this screen here, this is what we're trying to show here with active portfolios growing faster than our active customers. So Brendan Malone is an active customer, but Brendan Malone has a kids account for Isabel and a kids account for Tom. And then I have a jar for school fees. So we want those relationships. And you can see that we've had a growth, an increase of 17% over the last 18 months. There's still some work to do on the interface and the user experience to say, I get upset when I meet someone on the beach at Nippers last week and they said, I use RAIZ, but I didn't know you had RAIZ rewards. And I'm like, what do you mean you don't know we have it? So getting that user experience right and getting the right product or the right message in front of the right customers is really what we've worked on the last 18 months, and we can see that it's growing, improving.
I've got a question here. Let me just see. Yeah, questions on the questions more around the roadmap in terms of started off as wrapping up spare change. Now it's a more kind of full functional financial fintech app. And the question is, how do you kind of stay away from customers wanting to do all sorts of like weird crypto stuff and commodities and where does the feedback kind of stop at, okay, customers want this, but it's not actually in keeping with our kind of overall ethos of what we want RAIZ to be?
Yeah. Look, I think that's a good question because I think it comes back to our strategic pillars and what we believe in over the years. And you think about the last 10 years, we've been through so many thematic exercises. Hey, you should be jumping on AI. That's one. A couple of years ago, it was buy now, pay later. We had a lot of feedback from both investors, partners, etc. You should go into buy now, pay later. But what we've done is we stay core to what we believe and what we offer, and that is breaking down the barriers to saving and investing. We stay true to that, and then we are building the product roadmap in that ethos to say, well, what does the customer need next? If you're a customer 10 years ago at 20, what do you need now? We're very, very lucky. I mean, we sent out a survey to our customers about 10 days ago, and we had over 62,000 responses to an in-app survey. Now, that's a highly engaged database telling us what they want. If we've got a roadmap. I know the board and the management team know what we want to do with our strategic product roadmap. We've got the North Star. Now we're sitting there going, okay, what comes first? What does a customer need on their journey as they go through? Should we move this forward? Should we move that back? One of the slides I was talking about was the instant payments and then getting on the MPP. That is key to HIN trading. So we need to put that first. We listen to our customers, but the customers tell us exactly what they want to.
And sorry, Brendan, I'm just looking at my email here because somebody's emailed a question in. Brendan, you've talked about M&A. What areas are you looking at? Is bringing on another small superannuation fund to give a bit more bulk to the super product? Maybe just touch on M&A.
Yeah, look, it's obviously a big topic at the moment across us. We've hit that structural profitability. We're well funded. Our space from 10 years ago to now is overcrowded, and we've got a few more competitors in there. So how do we? And the biggest thing is we're all chasing the same retail dollar. There's not that many funds out there in Australia that has over $2 billion of funds under management. And we know our competitors are trying to pick away at that. So we look there and sit there and say, well, what is the ecosystem? What, from an M&A point of view, there's sort of three things. I'd love product. I'd love customers. Ideally, I'd like products and customers in any sort of acquisition. When we sit around, when the board and the management team talk about it, we look for those opportunities. I would absolutely love to, find some smaller superannuation funds, and there's a few out there that I believe what we offer and how we offer it through a digitalized solution would benefit the customers or the members from a reporting and efficiency of time and real-time information. So I think there is some opportunities out there that be beneficial for the organisation or the members of those funds, and that is definitely on the radar.
And maybe if we stick on capital management more broadly, obviously as you move into kind of more consistent, profitability, right down to the NPAT line. I mean, that does open up levers like dividends, buybacks, yeah, maybe just kind of talk about, where the board is kind of seeing, those capital management opportunities or levers.
Look, it is a good conversation at the board, especially with the board members that we've got that have got the experience in this. We both Alex, our CFO, and I, we have healthy conversations and discussions. We have a pretty strong capital management plan. We know where we need to go, what we need to do. We do, obviously, you've got to recognise that you have to continue to invest in your business, your tech and your products and things like that. So we've got to get that balance right. We've got cash on the balance sheet. There's no way we want to go backwards from a P&L point of view, but we also recognise, and we've had conversations at the board saying, can we supercharge our growth? What does that look like from a marketing spend point of view if we've got some extra cash in the bank? So it's a pretty strong and healthy conversation about what we do with our capital.
We've got payday super coming in now at the start of the next financial year. Does that have a major impact? Instead of getting super payments into the super product every quarter, maybe now you're going to be getting them weekly, every second week. It's like linked to people's pay cycles. Does it have much of an impact profitability wise? Have you guys looked at what it might mean, or is it just something that's going to happen and it's not a major impact?
It won't impact us from an operational point of view because it's all done through our system and our tech stack. But what I'm happy about it is from a customer point of view, because we have a superannuation product that your employer can pay the SCG into it, or super guarantee into it. The customer can see real time that they've been paid. Remember the days where you used to have to wait every 3 months or every 6 months to get something in the mail. Young people change houses, they never see it. This will be real time. So it's putting a lot of control back into the individuals to say, hey, have I got my superannuation paid? From a fund point of view, it's great for us because it will continue. It's just, what I like about the super guarantee is it is a regular contribution. Yeah,
no, exactly. And I know it's not in there. And you talked about, re-engaging with customers, and that was a feature at your last presentation, Coffee Microcaps. I mean, have you got a split or a sense of, how many customers are re-engaging versus new ones in terms of, driving that like active customer? Because I think, the last time you'd really started to focus on re-engaging customers and it had shown some, nice promise and you were getting some early wins on. So maybe just give us an update on that.
Yeah, I think the last time we put our fees up, which is always an interesting exercise to both existing customers but it does give us a reason to talk to inactive customers because we've improved the product and they might have left because the product that they wanted wasn't on the platform. So with that exercise that we released that on the 1st of August, that exercise there, what we're very happy with is that our existing customers are staying with us, and you can see on the slide that they're going deeper in that relationship. I think the biggest challenge that I put out to the marketing team is we know that if a customer stays with us for 3 months, they stay for a long time. So it's getting them over that initial hurdle. And if you think of, say, January was a great month of acquisition. We added 4,000 plus over that period. But with the market volatility now, a first-time investor, no, we want you to stay. You've got to understand it. Someone rang up the other day and said, "Oh, the market, I'm worried about it." And I heard the customer support say, "Well, have you looked at your account?" And his $20 was now $19.87. Oh, okay, so there's nothing to worry about. No, mate, there's nothing to worry about. So it's that hurdle. The top of funnel is still very good. I mean, it died off a bit in the fourth quarter, but that was across everybody with the November movement and the seasonality of Christmas. But we are now focusing on how do we retain the customers that we've got, go deeper in, because it is a big, big driver of ARPU. We've done some homework to say that customers need to see RAIZ 14 times or 14.3 times before they will download it and put money in it, because it's an educational process. It's not something you want to buy. It's not a widget or something functional. RAIZ is about an education and a financial services journey. So we're just continuing to, customers sign up, but they don't deposit. So they're in our environment then, so we can keep continuing, keep nudging and get them in that customer flow to convert them. And
churn, people deactivating, or having a balance and switching it to, one of your competitors, or saying, oh, it's not really working. I mean, has that decreased over the 10 years as you've got a more fuller ecosystem there? Like, oh, I used to just use it for roundups, but now I'm actually using more of the product. So, has churn decreased over the 10 years, do you think?
Churn stayed the same. The numbers obviously changed because the actual customer base has increased. Bigger, yeah. But it sits sort of, I mean, I could pretty much do it not market specific. If the market's on the way down, either customers won't sign up or they might panic and pull out. But we have an education process in there, or we provide that move to a defensive asset, being a RAIZ property fund, or we've got gold ETFs on there, or a AAA for cash. It is more, so it stays pretty consistent, but depending on the market, it is a seasonality thing. We did see some customers go inactive, as in they took their money out for December, but they've had a savings goal on a weekly basis for $50 a week, so that when Christmas comes and they know they might have to travel for family or buy presents and food and all that sort of stuff, it helps them out when these Australians out there are living day to day or week to week or paycheck to paycheck. So we can see that, but then in January they go, right, New Year's resolution, get fit, save money, away I go again. And then I could pick a whole cohort of customers that will do that. So there's no, we're sitting anywhere from 1.2 to 1.5% on a monthly churn basis. We report on a net active customer basis, but if you annualize that, it's sitting at sort of 16%, which is sort of in line with any sort of retail service, financial services product.
Yeah. Okay. Perfect.
I'd love to continue to get that on the other way, slow it down. And I think we're doing that with the wider product offering that we're putting in front of our customers.
Yeah. Brendan, we will leave it there because we're just bang up on time. Thank you very much for coming back and giving us the update, and good luck with the 3 big product launches for this year. As a RAIZ customer, I'll await the in-app notification say it's live, and we'll test it out.
I'll get you on the testing, Mark.
Yeah, cheers. I'll be happy to be part of the beta group.
Brilliant.
Okay.
I'll stop sharing now.
Yeah, you can stop sharing now. And our final presenter of the week, of a big week here, we 21 companies presenting this week. We've got Rob Veitch from Aerometrex joining us from Adelaide. Good morning.
Morning, Mark. How are you?
Very well, thank you. And yeah, your cover slide just came up now. Rob, you can take it away whenever you're ready.
Okay, thanks, Mark, and thank you for everybody who's joined to show an interest in Aerometrex. I think I'm going to go through some information about the company first. I know there'll be some people on this call who would have also been on the previous one that I presented about 6 months ago, so I might go through the company stuff a little bit quickly, and then spend a little bit more time on our half-year results that we just released, and an update on some of the things that have been happening since I last presented. So disclaimer here, I'm not going to go through this, but please feel free to read it if you feel the need to. Just a little bit around who we are as a company. So Aerometrex was established in 1980. We're headquartered in Adelaide, around about 100 employees across three different offices, and obviously a lot of pilots and remote staff around the country as well. We opened an office in Sydney this year, so that's our 3rd office, along with Adelaide and on the Sunshine Coast. In 2012, we developed a proprietary 3D modelling solution, which we've evolved and we still offer now. 2015, we acquired a LiDAR business out of Queensland called Atlas, so this is now rolled in underneath Aerometrex. And in 2018, we introduced MetroMap, a subscription-based image solution where we capture large parts of Australia on a regular basis, and we feed them up either through a web browser or through an API solution. In 2019, we were listed on the ASX under the AMX ticker. and we began, I guess, the focus towards becoming more of a subscription business and less of a project business. In terms of our company profile, so we're, I think the numbers were from a couple of weeks ago before we released our results, so we're sitting at around about 32-cent share price now, 30 million market cap, cash balance that has been stable for a while now, sort of around that 3.5 million mark. Stable board as well, so we've got, I joined the board middle of last year. I think prior to that, all our other board members are long-term board members. And we have a mix of founders, retail, institutional shareholders across the board. A little bit about our vision and our purpose. So I'll go through this quite quickly, but I think we're a geospatial solutions company. We try to provide insights to our customers to help them make faster and better decisions. We operate within the values of curiosity, leadership, empowerment, accountability, and respect. And in terms of what we do as a company, I'll just go through some of the key offerings. So fundamentally, three different offerings here. So we're talking about aerial imagery. I mentioned provided through the MetroMap subscription, airborne LiDAR, which I think is done on a project basis, and 3D modeling, which is also done on a project basis as well. So a little bit more information about the imagery side of things. Like I said, we offer this up through a subscription basis. So you're looking at regular captures throughout the year. So typically we're doing the capital cities around 4 times a year. We're doing outer metropolitan areas twice a year, regional areas once a year. We have recently increased that capture area. So we're now doing Sydney CBD 6 times a year. And we've certainly expanded our coverage as well. So we're doing that. We do also do this on a project basis in an opportunistic sort of way when customers want something that isn't on MetroMap or want something on a particular date or in a particular season. We can do it on demand as well. We offer aerial vertical imagery, but as well as that, we offer oblique and near infrared imagery. Elevation data, what this means is we can measure the height of the ground or the buildings, and a whole heap of other things, including AI-derived insights such as swimming pools, solar panels, things like that. Just to explain that a little bit more, so the vertical imagery or the nadir imagery, so this has been in play for a long time. We've been capturing oblique imagery. We've added this to MetroMap in the last 12 months, so this is a big addition. And we also offer at select times throughout the year near infrared imagery, so monitoring things like tree health and all of those sort of things. In terms of our LiDAR business, so classified point clouds, elevation and topography maps, insights and analysis. So I think we, probably about a third of our business here is mining and resources. So we're measuring stockpile heights and things like that. We're also doing vegetation management, tree canopy heights, things like that, coastal erosion, flood risk, things like that as well. So it's quite a wide range of different applications. For these products, we own our own planes and our own sensors. So we run 5 planes around Australia, and obviously employ pilots and sensor operators and everything that go with that. So our 3D offering is effectively a combination of the 2-dimensional imagery and the 3 dimensions of LiDAR. So this is a fully photorealistic 3D model. We offer 3D mesh models for context layers and for various different visualization purposes. We can offer 3D building LOD models or level of detail models. So this is a simplified version of the different buildings that is often used in various different applications for local councils and other software platforms. And we can measure 3D change analysis as well. So I think if you watch our announcements, you might have seen last year we did a big project for the South Australian government where we were measuring sand movement throughout the course of the year. So we capture basically going back to do the same capture multiple times a year, and we're able to monitor the change over time in the movements in those sort of things. So we also offer 3D as an off-the-shelf product as well. So we build 3D models of all the capital cities each year. Quite up to date, everything here, quite large areas. We're starting to capture larger areas as well and build larger 3D meshes. So these are available on our website. You can go in and circle a certain area that you want. You don't have to buy the whole model. But yeah, these are available at any time if you want just a particular area of a particular model. So the use cases for all of these products, I did mention some of the LiDAR use cases, but infrastructure, utilities and engineering. So primarily these companies are using things for design and planning purposes, or they're using it for change detection over time. So they want to see what things looked like previously, what they look like now. Environmental kind of issues, so simulation of floods and erosion, things like that. Telecommunications, line of sight, things like that. And a whole lot of, I guess, a growing number of environmental, agricultural and resources type kind of applications. So things like bushfire load monitoring, erosion, flood, risk monitoring, all of these sort of things. So really, really very wide range of applications. And what we try to do is choose the best solution for the particular use case. So rather than offer customers one specific solution, we try to understand what their problem is and offer one or a combination of these three solutions to suit the customer need. So you'll see a wide range of customers, so everything from Google to REA to government organisations, large engineering firms, airports, those sort of things. So I think very wide range, and I think you'll see everything from single person businesses at one end of the scale all the way through to enterprise, larger government organisations. So really a very wide range from small to medium all the way up to enterprise businesses. I'll skip through that. I'll go. In terms of the market size, so I'll go into a little bit more information around where we're currently at with these, but we think the current addressable market for MetroMap is around that $120 million a year. So I think you'll see on one of the subsequent slides we're about 12.3 at the moment. So we think the total addressable market is about 10 times what we've got. And it's a growing market also. I think on the LiDAR side of things, we're sort of sitting around about that probably 11, 12, 13 million range or whatever. So we think the available market there is 4 to 5 times bigger than what we've actually got at the moment. And 3D, smallest part of our business at the moment, but we think is a blue sky opportunity where the entire world around digital twins and things like that, the world is getting more 3D. So we think this is a blue sky opportunity. A little bit about our results that we've just released for the half year. So we recorded $12.93 million of revenue for the half. So that was up 12.3% on the previous year. So that was a good result. Our EBITDA was $3.55 million for the half, up from 1.05. So that was, I think, a 230% increase from the previous year. That was a pleasing result. Cash flow from operations from 0.65 million in the previous half or previous corresponding period up to 4.11 million, and our cash balance is stable, has been stable for 3 quarters now. So that's also a pleasing result. Our annual contract value throughout 2025 went up nearly 32%. So I think for a SaaS or a DaaS business, I think that's an outstanding result. A little bit more insight into those numbers. So I mentioned total revenue up 12.3%. Our MetroMap subscription revenue was up 21%. Our LiDAR project revenue was up about the same number, so a bit over 22%. And all of our figures around EBITDA, cash flow from operating activities, were all very large increases from the previous period, and also our free cash flow has gone positive during this half as well, which is again another very pleasing result. Some of the things which have gone down a little bit around MetroMap Insights, so you'll see that has dropped down to zero. So we stopped offering that as a one-off product. We now offer that only through subscription. So that's the reason for the drop off in some of those sort of things. Just a little bit on the the earnings leverage here. So I did mention our EBITDA is increased a lot, and it's certainly from the previous corresponding period, but our half-year EBITDA was actually exceeded our full-year FY25 number. The result of this, I guess, is the increased top-line revenue certainly helped. You'd be aware that we undertook a strategic review last year and took around about $2 million worth of cost out of the business. So I think both of those two things obviously had the largest effect. I think we're also starting to see the benefit of the improved quality of the revenue. So we're getting an increase in subscription revenue, and I guess with the fixed cost base of this business, we're starting to see improved EBITDA through a different style or a improved quality of revenue. I think the final one, I guess I mentioned, we own planes and sensors ourselves. We've been really focused on increasing the utilisation, not having planes and pilots sitting on the ground, but actually getting them up more often. So we're trying to certainly focus on that, which I think, again, I guess allows us to spread our fixed costs across a higher revenue base. A little bit more information on our revenue. So our MetroMap revenue now accounts for 44% of the total company revenue. So this is growing. Our ACV grew 32%. Our revenue only grew 21%, and I think that's because ACV is, I guess, a leading indicator of future revenue. So we certainly expect our MetroMap revenue to continue to grow throughout the coming periods, and certainly probably not that far off being 50% of our revenue. LiDAR still represents a large part of it, and you'll see the other ones are around the off-the-shelf and 3D products, which are I guess sort of stable. Just a little bit more information on our MetroMap revenue. You'll see, like I mentioned, so the half-on-half revenue increasing. Second half we expect will increase again because of the ACV growth that we've had in the first half. So I think the growth that we achieved just in the first half of FY26, I think annualised accounted for about 35%. So certainly everything going along very well for MetroMap, and I think we did mention in the full year results our cost of delivering the MetroMap program is sort of in between that $11 and $12 million range. So we're above that now, and so certainly every new MetroMap customer acquisition, about 80-90% of that goes to the bottom line now, because our fixed cost structure doesn't change as we take on more revenue. Just a little bit more on the MetroMap thing. I mentioned this earlier, but I think some pretty significant product upgrades over the last 12 months. Certainly, we did a very critical analysis of our product about 18 months ago, looked for reasons why we weren't winning some customers, and were very honest with ourselves about some of the we needed to improve on. We've added, I mentioned, oblique imagery into MetroMap. So this is a 45-degree north, south, east, west sort of image, and not just a vertical one. Elevation data contour lines, so customers can generate 3D insights and not two-dimensional ones. And we've completely redone the user interface. I think it's worth pointing out that this is stage one of the product upgrades. We've got plenty more exciting things that are in the works at the moment as well. The other area, I guess, where we did see some gaps was the the coverage and frequency. So we've added about 8,000 square kilometres of additional imagery. So we now cover 94% of the population. So it was 18 months ago around about 89%, and added about 56 new and extended areas in key growth corridors. Increased our Sydney metro capture to 6 times a year, and we are looking at, I guess, some of the other capital cities just based on customer input as to whether we might do them a bit more frequently. And we've added in the Hunter Valley to support the resources sector as well. So I think what's important to note here with all of these additions as well is that we've done this entirely through efficiencies that we've gained with our outsourced aviation. So I think we're flying within the same cost base. We're not adding more cost in when we add this extra flying. We're doing this within the same fixed cost structure that I mentioned on the last slide. So our project revenue, you'll see it's not a full bounce back from to FY24 levels, but certainly we had a 20+% improvement in our LiDAR revenue. You'll see from this graph that our second halves have typically been better for LiDAR than the first half, and I think this is pretty consistent across most of those years. So certainly we would hope that our second half would be at least the same as what it is now. And I think, if you doubled that number for the half year, we'd sort of be back up around that 13 million for LiDAR, and that's sort of where we would like to be, around that 13, 14 million again, if everything goes to plan. 3D down a little bit off the previous year. I think the second half of this is definitely looking better, but coming off a small base. So we continue to look for 3D opportunities in Australia and the US, but I think again coming off a small base. So I think this is the last slide, but I just wanted to talk about this one in some detail. I guess the investor value proposition. So why now for Aerometrex? Why would you perhaps want to buy in? Why would you want to become a shareholder at the moment? I think it's an important question. It's a question I get asked a lot, and certainly since we released our results, have had these discussions with many different people. I think the first one I was going to mention is just we've had a clear inflection in our financials, so double-digit revenue growth, across Metro Map LiDAR and across the whole company as well. We've got stability in our cash balance, so I think previously we were burning some, but I think we haven't burnt any since March of last year, so we've got stability there. We think with the growing Metro Map revenue base that we'll start to see some uptick in that. So certainly stable cash balance is not what we're aiming for. We're aiming for that to start going up, but I think it's a very positive thing that we're achieving this growth and not burning through cash at the same time. So we're doing it in a very measured way. Significant EBITDA growth that I already talked about, and now we're generating free cash for the first time also. Metro Map as a business, I think, is a very good business, and certainly when you get to that break-even point in a SaaS or a DaaS business, it becomes a very good business very quickly. I mentioned every new customer we acquire now goes largely to the bottom line. So this is a very positive business model. I think it's a proven scalable model as well. We know the total addressable market out there. Really only have one competitor in the market, so I think that's a great opportunity. I think the product upgrades are something to be really excited about as well. Like I said, we were honest with ourselves around some of the deficiencies that we might have had. We've closed the gap on them, and I think now we're focused on actually generating a gap for ourselves and offering unique products and not being in catch-up mode. And I've mentioned a few times the fixed cost base, so everything we do from this point on is beneficial. It's worth mentioning the team that we've put together as well. So we've refreshed our sales team. We've brought in industry veterans, so people who have done this before and know how to sell our products, know how to which sort of customers to talk to, and understand use cases, things like that as well. We've got a strong leadership team in place. Reorganized. I think I mentioned at the last one, we've got one Aerometrex model here, so we don't operate in business units or silos anymore. We operate as one company, one production team. Our sales team can sell everything, and I think has created a lot of efficiencies across the company, and certainly certainly something that makes us more of one company. And also the expanded footprint in Sydney with the Sydney office. So I spent a few days in the office this week, and certainly very, very good vibe to get all of our previously remote employees from Sydney together, and a lot of energy. And I think we'll start to see the real benefits from that as well as we build up primarily our sales team out of Sydney. And I think the final one I wanted to mention is just the growth potential of the company. So I mentioned the large total addressable market that we've got in Australia, but I think also with international options, there's really not a lot of countries in the world that have metro map style products. So I think there's effectively an almost unlimited list of countries that are possible. I think there's ongoing corporate development opportunities, which we talked about a little bit during the strategic review. I think they still exist. They still are something we look at if it makes sense. I think the huge data library that we have offers a lot of potential in the AI ML space as that becomes more dominant across all businesses. And I think with both of the businesses, the Metro Map and the LiDAR and the 3D business, we have revenue upside without spending any more money. So I think that's a real positive as well. So I think with that, I've probably gone a little bit over time, but I think I can hand back to Mark and see whether there's any questions that have come through.
Yeah, we've had a couple of questions come through, Robert, just while you were going through the deck there. And the first one, can you provide some more insight on what's driven the acceleration in Metro Map growth? Is it price increases, some kind of large client wins that got onboarded in the half, or a general reduction in churn, or maybe it's a combination of all three there?
Yeah, it sort of is a combination of all of those three things. I think the first one I'd say is certainly the product upgrades have helped a lot. We did have some gaps before. We don't think those gaps exist anymore, so that's created a more compelling offering out in the market. I think the energy levels and I guess the culture of our sales team has changed as well. So we're simply talking to more customers, having more meetings, and greater understanding of those sort of things as well. We haven't increased prices really, so I think there's the opportunity to do that in the future as our product becomes even more compelling. But yeah, primarily a result of product upgrades, talking to more customers, and I think it's probably worth also mentioning the reliability of our product as well. So capturing at the rate we say we're going to, we're doing what we say we're going to do.
Yeah. Just on the sales team, just one on that. Can you detail changes you've made to the sales team and how many resources have been added overall?
Yeah, so we've turned over, I would say, a large part of our sales team. I would say we've brought in, I did mention on the Metro Map space, we've got one competitor. So we've brought in people who know how to sell this kind of product, know the kind of customers to talk to and the story to kind of tell. So that's made a huge difference. I think, like I said, I think just the energy levels and the number of customer interactions we're having is probably one of the biggest factors. We don't have a larger team as such. I think we've got a similar number, maybe even a couple less in our sales team than what we had a year ago.
Question on the LiDAR business. What are the underlying customer industries that drive the LiDAR revenue? Is it primarily the resources sector, or are you doing stuff for agricultural, local, state government?
Yeah, so it's quite broad. I think it's around about a third of our business is mining and resources in the LiDAR space. So I think we also do quite a lot of work for the government, environmental sort of work. We've obviously some of the bigger projects we've announced. Around in July we did a big project for Shell, QGC, and I think we also, I guess, are getting increasing amounts of carbon farming and those kind of environmental sort of projects as well. So companies like Agronomy is certainly a growth area for us.
Another question here. Are there any industry sectors in terms of customers which you might see upside in, or where you're maybe underweight versus a competitor?
Yeah, I mean, I think there's a huge amount of growth available in the mining and resources area. I think it's a competitive space, I guess. There, I think the growth area is probably the environmental side of things, so the carbon markets and some of those sort of companies. I think there's more of those companies coming along. I think it's a different kind of process, I guess, where mining resources have been using LiDAR for a very long time. They don't need it explained to them, whereas I think with some of the newer businesses and new industries that haven't used LiDAR before, it's a slightly longer sales cycle just to educate them on the benefits of the product.
And we'll squeeze in this last one. Operating cash flow at 4 million was up a lot versus the PCP and ahead of EBITDA. Was there any unusual cash upfront movement? So yeah, maybe just I think the question is around, cash and EBITDA not kind of lining up kind of as one would expect.
Yeah, I think so. I mean, it's simple, two simple measures. The revenue's up, the costs are down. And then I think the other one I mentioned in the presentation is just the different quality of revenue. So I think Metro Map revenue from this point on is adding a lot to our bottom line.
Okay, perfect. And then one for me, maybe a more of a broader strategic. I know you have gone through the strategic review, but given where Metro Map is going, would it make sense to divest the LiDAR business and the 3D business and be a standalone pure play high-tech geospatial company, or does it actually make sense given the LiDAR data is feeding into Metro Map to keep that business in there, and then 3D could become a very nice feature within Metro Map rather than a standalone business?
Yeah, I mean, I think both of those angles are valid ones, I would say. I think having a LiDAR business is unique, and our competitors don't have all of those three options available. So I think there's some uniqueness in us offering that, and certainly our future product roadmap is I guess potentially becoming more three-dimensional than what it might have been. So I think there's validity in that, but I also think that from the strategic review, the value of our individual business units, if you add them up, the sum of the pieces is higher than where our market cap currently is. So I think I think both of the points you make are valid ones.
Okay. Rob, we are bang on time there, so we will leave it there. Thank you very much for coming back in and giving us an update. Greatly appreciated. And let's hopefully chat later in 2026.
Right. Thanks very much, Mark.
Thanks, Rob, and thanks everyone for joining us this morning. That wraps up our busy week of webinars, and our next webinar will be happening not next week, the week after, March the 19th. We'll have another 4 companies presenting then, so please watch out for the email going out for that. And I wish everybody a good rest of their Friday and a good weekend. Thank you.